Point. Looks like we're live now.
Yeah, it looks like it. So, as people filter in, this is going to be recorded and shared. Just checking that you're still able to hear me and see me. Okay. So, um, the goal of this is that one, actually we have a lot of crossover. There's a lot of folks that are subscribed to Bison Insights that are subscribed to your channel and that have listened to your interviews. But for the folks who aren't, Jesse is a leading commodities sector podcast interviewer and runs a leading commodity focused channel on YouTube and has interviewed me a few different times. And like I was sharing in the sort of morning chat for the for Bison Insights, I think my favorite part about chatting with Jesse is that after the camera turns off or the recording turns off, we chat about stocks, and he always has an interesting perspective. And I noticed that Jesse has, through interviewing all these very smart CEOs and fund managers and pundits and so on, has a very educated and nuanced perspective on commodities. And so, um, Jesse, why don't you tell us for a minute, if you don't mind, about your background and then about what you're finding compelling about. Actually, it'll be a three-part question. So, short background and what you do. What you are finding compelling about oil stocks, or at least what you were at the end of last year, and then what your process was for finding this one particular oil stock that was on Bison Insights, and sort of how you, without naming names, just sort of what was compelling about it versus sort of some of the other stuff that you were looking at. And I might interrupt at some point, but that's sort of the
Yeah.
general idea of what to chat about for now.
Cool. Yeah, feel free to interrupt. In terms of my background, it's mostly in broadcasting, which is kind of what brought me to doing commodity culture. Is that I started off with a broadcasting career in Asia, mostly in Beijing, China, and Seoul, South Korea. I started to get a little bit interested in investing at that time, but this was like mid 2000s. And I started to dive a little bit into the efficient market hypothesis, Eugene Fama and Kenneth French. That was kind of my first introduction to the world of investing. That was something I got interested in, but kind of put to the side, as at the time there was no online brokerage services. It wasn't easy to invest compared to what it is today. And once I came back to Canada, I started working at an investor relations firm in Vancouver called Kin Communications, and they had a lot of junior mining clients in the silver mining space, gold mining space, uranium. And at the same time, I kind of started to develop an interest in both the concept of sound money in the form of gold and silver. And I became very interested in energy. There's an interesting book. I don't remember who the author is. It's called Energy, A Human History. And that was one book that really got me fascinated. It goes through the history of energy from the burning of wood, whale oil, coal, all the way up to modern day with nuclear energy. And I just thought, you know what, I want to do something. I want to make some documentaries. I want to explore this topic further. And so I started my channel as a documentary channel. And I started off making a documentary on coal, and then I kind of went up the chain through natural gas, uranium, oil, and the uranium documentary hit it really big. And then that kind of helped launch the channel. And then I started doing interviews because I continued to do documentaries. I did gold, silver, platinum. I've done a bunch now, but they take around 3 months to put together. So I wanted to keep a steady stream of subscribers and people tuning in. And so, because of my broadcasting background, and I was already a big fan of shows like Kitco and Stansberry Research and the Jay Martin Show. So I was kind of getting inspired by those programs. And I decided, why don't I start interviewing people about these commodities that I'm making documentaries about? And that kind of brought me to where I am today. So that's kind of the background of the channel, and my own background when it comes to my understanding of commodities. And obviously, I've been able to learn so much over the around 4 years that I've been hosting conversations with people like yourself, and people who are experts in various commodities. It's given me kind of a multifaceted knowledge base from which to draw from, which is really awesome. In terms of what made me interested in oil and gas, so I didn't really start getting into investing until 2020. aside from my brief foray into the efficient market hypothesis when I was in my little room in Korea when I was living there. Um, and so I started to dive into it through the old school value investors, your Warren Buffett's, Howard Marks, Peter Lynch, people like this started reading their books, started watching interviews with people like Marx and Jim Grant and people like that. And so that's kind of what started to influence my approach. And so I started examining which sectors seemed undervalued or unloved at that time. And oil and gas was obviously front and center. And I just noticed that, the political elite hated it. It was getting disparaged in the media all the time. People I were having conversations with about it, it's like you couldn't talk about it to people in my friend circle, anyways, in Canada, because they just thought it was an abhorrent thing and it needed to go away. I mean, I'm from the west coast of Canada, which is often called the left coast because people are very left leaning and very environmental there. So I was just looking at how much hate the sector was getting overall. And then I was looking at these companies kind of through the lens of, at the time I didn't have much of a knowledge base about, what is a reserve replacement ratio, what is a recycle ratio, and a lot of the oil and gas terminology through which the sector is evaluated. I just kind of knew price to book, price to sales, price to free cash flow, PE, forward PE. So I was looking at all these metrics on the larger producers because I kind of have a bit of a risk aversion from the start, coming from that old school value investor standpoint. I'm not I'm not one of these people who wants to swing for the fences on 10 baggers. I'm just looking for, reliable cash flows, investing in something that's undervalued and making perhaps a 2 to 3x return over time. And so a lot of these big producers just looked extremely attractive on all of those kind of traditional ratios and metrics. And so I started kind of diving deeper into the sector, made a few investments in that space, and have kind of grown my knowledge base over time from speaking to people like you, people like Joseph Schachter, people like Shabam Garg. It's been a really fortunate journey how I've been able to kind of complement my initial knowledge base by talking to so many people who are so knowledgeable in the sector and drawing on that experience to make my own decisions. I'm still a novice in the industry. And that's why I think what we're going to get into a little bit later is why sometimes I need to, I don't want to say lean on, but just take into consideration points of view from people who have more knowledge than me and have the humility to take that into my own evaluation of a particular company or a particular sector. But one other thing I will say, that part of what I do in my journey as an investor is I also have to be able to listen to certain experts and believe that they're wrong, because everybody's got a different. And I speak to several people on my show who have been consistently bearish on the oil and gas space. And I listen to their opinion as well, and I have to take certain things they say into consideration. But one interesting pattern, I'm not going to name any names, but the people who've been consistently bearish on oil and gas that I've spoken to, I can kind of tell by speaking to them about it that they don't have a huge depth of knowledge on the subject, and they miss a lot of the pieces of the puzzle when they kind of give their spiel about why oil is going to crash to $30 or whatever. So that's kind of, I pay attention to both, the points that I agree with and disagree with various experts to kind of come to an overall conclusion. So I don't know if that answered your question, but that was
No,
my
that's
spiel.
great. Those are really good overview. So then can you talk more specifically? So you interviewed me, I think, for the Vancouver Resource Investment Conference, for their sort of online panel thing.
Yeah.
I think it was in December, and it was right around when I had published an investment thesis on a particular idea that was a large cap. And um, can you talk a little bit about sort of what you were thinking about doing? Again, not on a no names basis. This isn't about this stock is, the
Yeah.
particular stock is better or worse or whatever. But I'd be interested. I think people would find this particularly interesting because you ended up choosing a Bison Insights idea over a sort of very highly touted, popular value large cap US stock.
Yeah. So at that time, I was looking to add more exposure to the energy sector in my portfolio because, my energy stocks went on a bit of a ride, and that I initially started actually deploying capital to the sector in 2021. but I missed the run up after oil went negative and then the stocks did extraordinarily well. I was late to that party, but nonetheless, the equities that I selected performed very well for the next, I want to say, year and a half. And then there was a downturn in the energy sector overall. And, this is a little bit of a perhaps a foible that's not the best, but I really don't like investing in things that are going up. And so when I look at my overall portfolio, first of all, I already know that the setup for energy is extraordinarily compelling. That's already my thesis in my opinion. And I saw the stocks that I selected do very well and then go down into the negative. And I'm looking over my portfolio, and fortunately, everything else that I've been in, but the vast majority of the rest of my portfolio is uranium equities, gold and silver stocks, and a little bit of fertilizer exposure, and a little bit of emerging markets. That's basically the whole picture. And at that time, the rest of my portfolio was doing very well. Everything in the green, a lot of my stuff up 100, 200%. And my oil stocks were all essentially minus, as opposed, except for like, the XLE ETF. That was positive. But so much of the other stuff was down. And I already had done, my work on the companies I'd invested in, and I'd already been keeping up to date with them. And I didn't see any fundamental reason for why they should be dropping. And then, of course, you look over the rest of the energy sector and you see, okay, it's not my particular stock selection. It's that the sector as a whole kind of isn't performing well. But I think this is an opportunity either to buy more of what I already own at a cheaper price than I originally paid for it, or to perhaps look for a new company to invest in. And my portfolio was a little speculative at that time. I didn't have enough of those big names, those big anchor positions outside of like the ETF. So I was looking for another big producer that I could add. And I was specifically looking in the United States because I had concerns about the regulatory environment for the oil and gas space in Canada. What with the Liberals being so staunchly, anti-fossil fuels, pro-renewable energy, I just felt that they were going to implement more and more policies that could be restrictive for the oil and gas sector in Canada. So my thought was, I don't have at that time, I didn't have any exposure to US oil and gas equities outside of the XLE ETF. So I was thinking, I want to get a big US producer, not Exxon or Chevron, something else. And so I started to do some research, came up with a list of names, was looking at these, how undervalued they appeared compared to peers in the market. And I landed on one company that was, as you said, it was a very well-known company that a lot of people were talking about to do a merger. Maybe we can get into specifics later. And it just looked very attractive to me on a variety of different valuation metrics. And when compared to peers around the same market cap. And so I then came across, I'm a subscriber to Buys and Insights, and you were posting about some different ideas. And there was another company that was a big one of the bigger oil producers in Canada. And you also at the same time released some information in your newsletter as well about why the very company I was looking at, the merger was actually not going to be good for them. So I started to look at all of the research you were coming up with. And as I said, I'm not an expert specifically on the oil and gas space. So you brought up a lot of points that I wasn't even tracking. I just figured, the merger is going to be good because they're going to become a bigger company. And, that's great. They're going to become one of the bigger producers, and it's just going to give them more, long life assets. This is excellent. And you kind of pointed out some facts about that acquisition, I should say, that were not favorable, and in turn provided this alternative, which was in Canada. And that led me to actually dive a little bit deeper into what's actually going on with Canadian oil and gas regulation, because there's what politicians say and there's what they do. And although Mark Carney has been very moronic in terms of what he says regarding the oil and gas space, the fact is that it looks like policy is getting less restrictive, not more, since 2025. And although the industrial carbon tax is still certainly a very serious impediment. In fact, you listen to earnings calls from Canadian oil and gas companies, and the CEOs will often talk about kind of how they feel constrained, and that Canada's not incentivizing investment due to this industrial carbon tax and certain other policies. Of course, we know about the most recent news, which is the pipeline being built from Alberta to BC. Now there's all these concessions that need to happen, and this whole concept of we need to create low carbon oil. It's a bit of a problem, and there's more hoops to jump through. Certainly, I don't know if you put a gun to my head and say, "Will the pipeline get built?" I guess I'd say eventually. But it's all of these things that happen in the Canadian oil and gas sector, the indigenous side, how you have to consult. Of course, we should always respect people's land. There's no reason to be irresponsible. But the fact is that even though a lot of these companies are very responsible, it still requires consultation, which really means you're going to have to pay a certain amount to these different indigenous groups, and there's a lot of them. So, nonetheless, after I did that kind of deep dive on the regulatory environment in Canada, I realized, okay, it's not as favorable as perhaps in the United States to some extent, but the level at which these equities are trading at versus what their true value appears to be is pretty compelling in Canada specifically. And I think over the long run, although Mark Carney is going to have to say the right things, it does look like the policies actually being implemented are becoming less restrictive. So that gave me a little more confidence. And so I pulled the trigger on the idea you presented in the Buys and Insights newsletter. Year to date, I mean, I posted on X about how it was outperforming by 19% year to date. I think that might have been a month or two ago. It is now outperforming the stock that I was going to pick by 50% year to date. So, and it was interesting. I don't want to sound like I'm overly promoting Buys and Insights, but I talked to my wife about, okay, I'm going to invest in a new oil and gas company. I'm going to invest in this. And I kind of explained to her in layman's terms the different options that I'm laying out. And then when I laid out this idea, I was just like, there comes a point where you have to kind of defer to the experts. And if you're simultaneously, it was almost around the same timing that you were both putting out this new idea that I hadn't considered because I was only looking in the US. And then you also put out a report on how the company I was considering, their acquisition was not favorable. You called it diversification. You provided a lot of information on that. And so at that point, I said to her, I have to go with the expert on this one. Of course, I did my own due diligence on the new company that you had presented as well, and found everything you were saying to be true. And it looked very attractive, and so I pulled the trigger. And obviously, I'm glad I did. So I hope it doesn't seem like I'm putting Buys and Insights on too much of a pedestal. This isn't a commercial, but nonetheless, it was extremely helpful, and it turned out to be the right call in the end.
Yeah, I mean, the reality is that everything in life is a commercial in a capitalist society to some extent.
Yeah.
So, but I do appreciate it. And again, the goal of this isn't to garner some sort of like extreme endorsement. It's just to talk about the process. And sometimes processes, even good processes, lead to bad outcomes, and sometimes bad processes lead to good outcomes. This, it sounds like, was a good process. The only part that was uncomfortable for me was the defer to the expert thing. I think actually you might have been more optimistic about the Canadian oil producers than I was at that time. And I just happened to really like this particular idea. So I put up this chart, which I did an update on the idea this morning, which was totally a coincidence. Uh, Completely unrelated to doing this. I know it sounds weird, but just just trying to do a few updates after earnings season. And I was thinking about selling this particular stock, and so I had my analyst help me like pull together numbers and sort of think through like, hey, is this something that that we're gonna sell at our investment firm? And then is this something that I should close out as an idea because it's outperformed so much? And the answer was no. It looks like there's a lot more upside. But the reason to highlight this particular chart is that it shows, Jesse, your observation and thesis on the Canadian producers, the large cap producers actually not being so bad relative to expectations, where that analysis, just getting that right, meant that if you bought that basket, you'd be up 50% from the December 6th publication of this idea versus XOP, the large cap US producer index, up 31%, and then this particular idea up 74. So the idea, I think, was cheaper, and it sort of worked I think the value plus the catalyst is helping drive it. But I think the insight that you garnered, where I think you were actually more optimistic at the time than I was about the specific direction for Canadian regulatory policy and pipeline outlook and so on. And again, no one knows for sure what's going to happen. It's just a question of sort of how the market interprets it and what's going to get discounted into the stocks. But I think this, that material outperformance of the peer group of these sorts of companies versus XOP based on the particular insight that you came up with, and that you got comfortable with is actually it's noteworthy and worth highlighting. And then here, let's see. This thing freezes sometimes. Uh, let's see if I can. Yeah, okay, great. And then just the free cash flow yield for this one. Even here, it's still crazy cheap, but it was even crazier cheaper in December. And then the whole peer group was cheaper than I think the public company that you were looking at in the US at the time, which was part of why I think it was so compelling to get this exposure at the time. And then also why some of that US exposure was not so good. And then actually, there was a big asset transaction yesterday, and it's all over the news today as we speak. And this company that was diversifying has now further diversified or something and paid a record high level for assets due to needing to replace their inventory. Whereas this particular idea, has long-lived reserves and doesn't really need to waste money, let's say. Like they did their own deal that was high priced that people didn't like, but it came with a lot of production and, turned out to have been a steal. Whereas this alternative, and I actually didn't hate the alternative. I just think the relative value and it was just relatively much more compelling in my view at the time. And it sounds like you sort of came to that maybe from a little bit of a different perspective.
Yeah, and when I said defer to the expert, I didn't mean that I would completely rely on your analysis, but it was more that I was kind of looking at these 2 companies side by side at this point, and I hadn't been considering all of the downsides of this acquisition, and so when I put that into the equation and realized how much time you spend on this process, that's when I came to the conclusion that, okay, this Bison Insights idea is most likely superior to my own. Again, we don't know. I love that you use that quote. I've heard Howard Marks say that. It's my favorite Howard Marks quote that good decisions lead to bad outcomes and bad decisions lead to good outcomes all the time in investing. So actually, it you we both could have been right about this particular stock and it could still have underperformed, compared to the other one that I had chosen to select. And that doesn't mean that we were wrong. It perhaps in the long term it would have played out differently, but in the short term, obviously sentiment can drive markets, and so who knows? For whatever reason, some big scare comes over, investors related to the Canadian oil and gas sector specifically, and names start selling off. These sorts of events that we can't foresee can happen, black swans, all the time as well. And so I love that you highlighted that point. At the end of the day, nobody really knows. We're just kind of all making our best guess based on the information we have in front of us.
Yeah, yeah, for sure. I agree, and I think even we can even just be fully wrong. So not just from a perception perspective, but it's possible to look at something and say, "Hey, most likely." So for this idea that you bought shares of, part of the thesis was that they were going to go redevelop assets, and there was going to be better well results and sort of more synergies than people expected. And it's possible that they could have gone in and there could have been some unforeseen engineering problem or regulatory issue or some other thing. And there's always a risk there, and it could have just gone poorly. And so, um, you know, and that wouldn't have made it a bad idea up front, even though the outcome is bad. And I think that's where it's sort of this like mind twist a little bit where because in finance, ultimately you're judged based on your outcomes uh, over time, but like outcomes over time um, don't necessarily translate to uh, any individual outcome being perfect, and there's no guarantees. Like so, we have this like chart of of the ideas I've shared and how they've done. And again, like I try to tell people, and people get offended by this. I don't know why, but like I've shared ideas that have done better than average, and I hope to continue to do that. But like the odds of actually hitting this high are low. And if you hit, I think outperformance on 55%, or if you just oversize and you hit less than 50%, but you oversize your winners, that's how some of the best performing fund managers ever have, the Warren Buffetts and the Stanley Druckenmillers and whatever, they win not by being right all the time, but by owning a lot of um what they are right about, and then in some cases being right just a little more than being wrong. So this could have been that idea number 12 where it's down 45% or whatever. It wouldn't have been so fun to talk about it, uh, but there's always that risk. And why don't we talk about that a little more? Honestly, I don't know that we need to get into specific names uh, in this conversation. I think this is sort of a generally relevant. It's helpful, I think, to talk through some of these sort of higher level questions on commodities as well as on sort of investments.
Yeah, absolutely. Um, I do want to say as well that when I look at companies in the commodity sector, like commodities are very cyclical, as we all know. And I just feel like at this point in time, the oil and gas sector, years of underinvestment, which is a huge part of the thesis behind why I originally started looking at these stocks in the first place. But I think that cyclically, we're still in the early stages of a longer term secular bull market for energy. And you know what? Why don't we dive into the war in Iran and its impact a little bit? Did you want to do that? Because um, I feel like that is kind of not the best, simply because the reason that I was positioned in energy stocks was because I believe that over time the price of oil is going to go up. Obviously, organizations like the IEA constantly overstate supply and understate demand. And based on the real metrics that are out there, we know that the supply demand fundamentals are extraordinarily compelling for the sector. There's not enough new exploration and development that is occurring to bring new reserves online. Prices are getting higher to extract oil in the shale fields, the big shale fields in the United States. By and large, many experts believe that those fields are starting, the production is starting to roll over. I mean, the list just goes on and on of bullish fundamentals behind the sector. And of course, what happened with the closure of the Strait of Hormuz and the war in Iran is that it exacerbated and accelerated these factors that were already in place. And so we've seen oil suddenly spike to $100 around WTI and stay there consistently. And I believe that this situation is probably not going to be resolved anytime soon. Stephen, thank you. I noticed your comment there. I love commodity culture. Thank you. Um, and so I think that we will probably see these sustained triple digit WTI prices for longer than perhaps many are anticipating. But the fear, of course, and it's such a bad fear to have, but if this conflict gets wrapped up and resolved completely, and let's say the Trump administration says, guys, we're pulling out, that this is it, whether that's because of pressure from allies on the fact that, hey, we can't sustain this oil price, like this is not going to work for our society and our people, because it is causing a lot of pain worldwide at this point. So the fear as an investor in the sector in the short term is that that is going to lead to a major sell-off, because as I mentioned, in the short term the market's driven by sentiment. And so of course there's a paper futures market, which so much speculation happens on. And so we could see large scale selling in the paper market, and that could lead to much lower WTI prices on futures. And that could then lead to people start selling off the oil stocks, et cetera, a cascading effect. And so I think that's a very real threat that people need to be aware of. But from my perspective, I invest in these companies, and I think of it as ownership. I'm a part owner of these companies. That's the old school value investor approach I was talking about. Although this is cyclical, and people have to realize this is not like a set it and forget it portfolio where you just buy Exxon and then sit on it till your retirement or whatever. You have to be aware of the cycle, and there probably will come a time when it's time to sell these stocks. But I think if you have a long-term time frame, that could potentially be a buying opportunity as well. So it depends on your time horizon, because somebody with a shorter time horizon might want to, if they've made large profits already from this unforeseen geopolitical event, then maybe it would be best to start to divest yourself of some of these equities. But I think if you've got a long-term time horizon, we could see a big drop due to that happening as a potential buying opportunity, because eventually the fundamentals will be recognized by the market at large, in my opinion. What are your thoughts about that?
Yeah, I had a dinner earlier this week with the CEO and CFO of this multi-billion-dollar Canadian E&P, and the CEO, they've done very well. They're on their, like, 4th entity. They've sold stuff and just done extremely well, which is unusual. Unfortunately, over the last couple, decade and a half, a lot of these guys have lost people a lot of money. These guys have made them a lot of money, which makes me pay more attention. If you're the better you are at it, the more I think you people should pay attention to, for some of these executives have like lots of opinions and no returns they've delivered, and others have they don't normally opine on stuff. And he said what he thinks is going to happen is that there will be peace and that there will be a sell off, and that there are so many folks that are on the sidelines waiting for that sell off because everyone's so worried that there's going to be this big sell off associated with it, especially after all of these sort of fake outs. That what's going to happen is that peace is actually going to be a buying opportunity. And he thought that there would be a sell off for a week or less, and that it would be just a generational essentially buying opportunity, because that would be your sort of bottom into this multi-year bull market along the lines of what you're saying, where it wouldn't be as bad necessarily as like the April of 2020, just complete calamitous collapse, negative prices, but that it would be a nice entry point. And then that, the problem that people are going to have is that everyone is lined up to do this. And so the stocks might not go down much, and then they might just go up a ton. So he was thinking it sounded like down 5 or 10% and then up huge, and that people might get too cute and miss it. And, like they're seeing for their company, there's just this enormous lineup of folks that want to own the stock, that don't necessarily want that exposure to this whole war scenario like you were describing, and that want the exposure to the company are paying attention because they saw oil go up and are now expecting it to go down, but they want this thing anyway, and they want it after, not during. And so I didn't really thought about it like that before, but I think there is likely a dramatic increase in interest in the sector, but not necessarily an increase in ownership in the sector like you described. Maybe some short-term stuff, but not real sort of ownership. And so that's one perspective, one side of it. The other side of it is that right now oil prices should probably be higher, and they aren't, mostly because, I think, like, without a tinfoil hat on, just the sort of fake ceasefires, like, peace agreement, but then not over and over again, has introduced a lot of price volatility into oil futures contracts, which reduces the amount of those futures contracts that investment funds are allowed to own, because the CTAs and the hedge funds that own futures have risk budgets. They don't buy stuff with dollars. They buy stuff with value at risk budgets. They get like a percent value at risk or whatever and get to go deploy it. And so of course they use dollars to buy it, but these are futures contracts. So you're putting down like 1/100th or 1/10th or whatever the value when you buy it. And then, you suffer these large fluctuations in both directions, or you're buying options on the futures and whatever. So, there's been observable price suppression. I think it's about $25 worth of price suppression, where just this volatility, as well as the maybe increased odds of there being a peace agreement because there have been so many floated. Like, if there had been none of this and like zero talk of there being a full peace agreement, there was a ceasefire, like the actual fact pattern had played out, but none of the jawboning around it, I think would be probably 125 WTI plus or minus $5. And so that makes me even more interested in holding exposure here, because there's still the upside case, which again is calamitous humanitarian wise, but just purely economically. The upside case is that the war resumes and more energy infrastructure is hit, and there's some more permanent damage, or potentially, if the US loses and Iran sort of restricts flows out of the Strait of Hormuz for years to come, there's a real right tail scenario here beyond what we've seen. I'm not saying it's very likely, but there is that chance. There's also this other chance that the dip gets bought, and so I think it's really hard here to know what to do exactly, and I'm very open to any of those sort of different possibilities, the one you described as well, and I don't own this stuff. I've always thought there would be a potential disruption to flows and, owning oil stocks for the fundamentals and then also for this added benefit of geopolitical risk has been a core aspect of my interest in the sector. But I'm not sure that we have less supply disruption here than we did a year ago. We might have more, and I'm not sure we have much more that's priced in given the discount, I think, to oil based on that value at risk shock that we've seen to the commodity funds. I guess I'm curious about your thoughts on that. You hear a lot of different market analyses and perspectives across a number of different commodity spaces. What do you think about that?
Yeah, I think on the question of like holding through this, I think that in terms of if you're already invested in the energy space at this point, then I don't think there's a reason to sell in anticipation of some sort of peace agreement happening because things could go either way, as you mentioned. And every time I have tried to time the market and get smart, it has almost never worked out for me. So I have to, so my theory is just to focus on the fundamental value being presented by the commodity and the companies that I've selected that produce this commodity. And if that appears to be an attractive valuation for which it's selling, then just buy it and don't get too cute looking at charts and what's the RSI and maybe I should wait for the RSI to go down below a certain level and buy it. Um, or maybe I should wait for XYZ event, which will probably occur. This is kind of a mistake that I notice a lot of newer investors I talk to making is that, oh yeah, I bought CNQ or some oil and gas company and it went up 30% and I sold it because, it's going to go down again as soon as Trump says something's happening with peace. And then I can just buy it back for cheaper. And that game kind of works until it doesn't. Because at some point, you're going to be in a position where you've sold it expecting to buy it back cheaper and it keeps rising. And because of, I don't know what you'd call that psychological fallacy, whether that's a sunk cost fallacy or whatever, it's just so difficult for somebody to then go, oh, I was wrong, and I'm now going to buy it back for a higher price than I actually sold it at. That is almost impossible for human beings to do, and they'll justify it in their mind. So much of this game is psychology. So that's why I try not to get shaken out by these short-term events. And with geopolitics, you just never know how it's going to work out. And you said something interesting there about the energy sector kind of protecting, in a sense, when these sorts of geopolitical shocks happen. And actually, Louis Vincent Gave is somebody who comes to mind who talked to me about the energy sector being a defensive sector in his portfolio. A lot of people look at it as a risk-on sector, but he was describing how it's defensive because it's not only defensive in your portfolio, but it's kind of defensive in your everyday life because it protects you from the shocks of energy rising and your day-to-day costs, your cost of living, if you own energy equities when that's happening. So I think that's a really interesting lens also through which to view investing in the oil and gas sector, that it can actually be defensive as opposed to something that's risk on. And you're bringing up a chart here.
Yeah, yeah. Well, so I try to not sort of show stuff from my investment firm on this. And just to be clear, first of all, none of this is an offer, solicitation, or recommendation, but specifically this investment firm, the investment's only available to folks that are accredited and qualified investors. Like, there's not a solicitation. But we put out this thing in February about this sort of exact point where we called it the market because we're not really allowed to say you, but you are at risk from insufficient energy exposure, like you being a market participant, given how low the energy sector was relative to its share in GDP and of the sort of market GDP and or the country GDP. And historically, when it's gotten to low levels, it's not a perfect indicator, but it's a pretty good compass, I think, in terms of um, where you're at and whether you should have more exposure. And the nice part is if you bought a lot in 2000, then when everyone else was losing their shirts and their .com stocks, you were making a fortune over the next 8 years or whatever. And as the market did poorly over a while, in that time frame, you did really well. But then once it was a big percentage of the market, it was time, like you said, to get out of Dodge. And so you don't want to be there for that 2008. I mean, you want to be there for the blow off top and then you want to get out. And so, there's a lot of folks that look at this and say, hey, well, energy stocks are up a lot right here. Time to get out. Right now, we're at 4%, let's say, instead of 3%. And to your point, you were saying this slightly differently, but to your point, I think that's missing the forest for the trees. I think you really want, not you. Now, I want to own this till we get to that average 8, or maybe, I've seen, on a longer term average, it's 15 or something if you go back through the 70s. And we have a shot in a world, let's say we get to this $150, $200 oil price environment, which is not, it used to sound completely ridiculous. I just had these 250 WTI hats for fun, where like, at the extreme end of another 2008 type cycle, we might get there. But we could get there in 3 months if, the Strait stays closed, or a month if the Strait stays closed and there's a war and more infrastructure is destroyed. And so in that scenario, you could get, I think, up to 10, 15, 20%, which would be horrible for the broader market. This is not a bull market for the S&P or tech stocks or whatever. And I'm not really like a doomer. I just like, this, like you said, and like Louis Goff said, it's sort of insurance. And the crazy part is, and what really I think would drive this, and what you saw, that sort of '05 to '08 move up, or that really like, what was it? This move right here. I'm not sure how to show the cursor. Yeah, there we go. Right here, that move from below, from the .com average to that line. There's that sort of vertical line there. I feel like we're sort of in that world right now, but just in the early stages. And so that was not a fun time to have broad market exposure, and that was a fantastic time to have energy stock exposure. And I'm not sure, I don't know. I'm not saying we are in that time, but it sure looks a lot like that or other similar times. And so I think when I think about that from like a allocator's perspective, I think, like I wrote here in February, and I think maybe it's even more true now, I don't think allocators have the right exposures. I don't think, these big brokerage firms have the right exposures that they're recommending to their clients. And the RAs, I know, for the most part, also, you read their stuff, they're all massively underinvested. They're all like excited about the opportunity in private credit. They're dumping more money into, this troubled asset class that's in the early stages of collapsing, not that's sort of in the early stages of a potential recovery after a decade and a half or almost 2 decade downturn. Anyway, I was rambling, but that reminded me, what you said really resonated, and wrote about it, and people got mad about this. They're like, "Oh, that's BS! Like, you're just a sector guy." Like, and it's like, well, okay, maybe, but here's the chart. You tell me, like, why should there be emotions associated with this financial market analysis and observation?
Yeah, and there's still people pouring money into the broad indices, the S&P, the Dow Jones, and the Nasdaq. And when you look at the valuation levels currently, they're out of control on so many metrics: Schiller PE ratio, price to sales, price to book, Buffett indicator. And of course, the interesting thing is, people say that, who was it? Sir John Templeton, who said the most dangerous words in investing are "this time is different." And then he also noted, however, at some point, that 20% of the time it can be different. Is the AI revolution, the so-called AI revolution, really that different these times? I mean, the valuations are absurd. We're in that mania phase when it comes to the broad market. That is, it doesn't repeat previous uh, instances like the tech wreck and the great financial crisis. But there's so many similar elements in that there's that herd mentality amongst people who are managing money. And of course, the big thing that's changed is the incredible amount of passive inflows coming into index-based ETFs. It's actually a massive, massive part of the market. And it's mostly people who are just chasing performance and going, well, tomorrow's going to be like today. And these indices have been going up for so long. at such a steady rate that it's just going to continue. And I think we're potentially entering an era where the traditional 60/40 portfolio is dead. And the problem is that so many people have been treating index fund ETFs like it's a high interest rate savings account. It's going, oh, all you have to do is put your money in an S&P 500 index, wait on it. Don't worry, it's just going to keep going up. Then you just retire and you have a bunch of money. Now, that has been the case since post GFC. It's been a very long bull market for tech and the broad indices. But I think at some point it's gonna, the market can remain irrational longer than you can remain solvent. Whatever, insert your quote from some famous value investor. But I think we're in that era now where much more caution is warranted when it comes to the broad market. And should we see that drawdown, whether that's a gradual decay, whether it's a calamitous collapse, either way, I think we're entering a world where people allocating capital are going to have to be more selective about what they're doing, and they're going to have to look for real value as opposed to just chasing growth. And I think in that sort of environment as well, energy will perform.
Yeah, I agree. I think that makes a lot of sense. I like that last spiel. I was just going to show everyone your channel. I think most people are familiar with it. It seems like there's 131,000 people that have found their way over there to subscribe on YouTube, which is phenomenal. And as we wrap up and as you think about Jesse's diverse perspectives um, across a number of different sectors, or sorry, commodities within the commodity sector, and a number of different really impressive fund managers and brilliant pundits and deep thinkers across a lot of different aspects of the economy and markets. I think it makes sense to um, to really think about what you're saying, and I appreciate getting your perspective. And it is sort of wild how these numbers. It's like my X account where there's like 130 something thousand. Like it's like hard to imagine connecting your. I saw one of your recent interviews. 91,000 people saw it. Like I guess as a last question, disconnected. So hey, okay. So we both think that oil prices probably go up and oil stocks probably go up over a medium term, let's say,
Yeah.
with potential short term negative volatility. And that's not something that anyone should rely on. They should figure it out for themselves and figure out if they want to own or not own stocks themselves. What's it like? Uh, you know, I think folks listening are probably interested because the odds that when they publish a video, 91,000 people will watch it are low. What's that like for you to experience that? Does it change how you um, think about the conversations that you're having? Does it change how because you've been doing it for a few years and you grew it from zero. So your first interview, you get 100 people watching it and now 400th or 1,000th or whatever, you get 91,000 people looking at it. Does it change how obviously you've learned a lot in the few years that you've been doing this as dedicated to this, but the thing itself, does is your experience different from that? Is there something that you can share with people in terms of like what you've learned, not necessarily from the guests, but from the process of building out sort of a larger audience?
Yeah, it actually makes me more mindful in realizing that I'm reaching a lot of different people. And so I want to try to get them useful information as much as I can. Um, and so it really affects how I'm crafting questions when I'm interviewing my next guest, considering that a lot of people are tuning in. Of course, we don't give any financial advice on the program. We explore different investment concepts. We talk a lot about geopolitics. We talk about politics as well, because that's all highly relevant to the commodities markets. But it definitely impacts my approach to crafting the questions, which type of guests I'm going to book, and just being mindful that people are tuning in there. They want to get value from what I'm putting out there. And so that's really important to me. And actually, outside of the interviews, the thing that really blows my mind, because when I was a student in elementary school, middle school, high school, I was so against the system. I was always close to last percentile of my class. I was always skipping classes. None of my teachers believed in me that I'd become anything. And I have the most viewed educational video in the world on the subject of platinum at 1.7 million views, and there's nothing else that comes close. I have one of the most viewed educational documentaries on the subject of nuclear energy and uranium at 1.3 million views. And so those are the things that I feel are like my legacy, because people are, and I get comments from kids who are watching it for their homework, who are writing a report based on it. And so many people are tuning in to learn about these commodities and how they affect our day-to-day lives. So those documentaries, which everybody can search up, there's a playlist on commodity culture for my documentary work. Those I see as kind of a big part of the ultimate legacy that I'm able to leave, where people can actually get real education from as well. So I don't know if that answers your question, but
No, that's great. I just figured I'd ask since it's particularly rare. It's great to get your expert perspective from interviewing so many people on sort of what you've distilled, which you shared with us in terms of your thesis on oil and just how to think about a commodity cycle where it's not forever, but it's also not for a minute. And to think about sort of holding periods and potential volatility and so on, but also, your experiences, it's not unique, but it's very rare. And so, and you clearly have a talent for this. So it's helpful to hear sort of where you're finding sort of value and what you've learned out of that. So thank you for sharing that. Okay, I think I'm going to wrap this up. Thank you so much for joining me and for joining us here on Bison Insights. I hope this was productive for the folks that listened, and I hope you enjoyed it. And I'll probably end up publishing this first for Bison Insights subscribers, and then releasing it over time to the general public.
thank you for having me on, Josh.
Thanks. Take care.